there's the open meeting notice about live streaming everyone. For Matt Frattini and Mike Chase, it's sort of a new world. We're so used to having Max Starks be here for years and years. We've got Trustee Norm Roldan, who represents the quorum of one. So of course, when the clock strikes 4:30, I think we're good to go, Norm, for you to help call the meeting to order.
Okay, we'll do thanks. 4:30, right?
Yes.
Okay.
And we're there now, Norm. And so
Yeah, so let's start. Yeah, so let's start the meeting in order. Do we have the minutes from last week we have to approve?
No, you'll see the
last meeting
agenda. No, we're all good. All you do is call it. She's going to roll call you in, Norm. It's a little strange with it just by yourself, and then we'll turn it over to the FIA folks.
All right, sounds good. Sounds weird just being myself, right? So let's start the meeting of the CCC financial meeting, and now pass over to Nanette. You're on mute.
Yeah, Nanette, if you'll call the roll, you're on mute. Yep.
Sorry. No, Roldan?
Yes.
Okay, thank you.
Of one, right?
One of one. We've got some of our extended team here, Norm, as well. I see, let me find them. Tony Montemagni, thank you for joining us as well. Good to have you. But again, Mike Chase will turn over to you and Matt, and hopefully you've got everything figured out with everything out there.
Okay, so good to see you, Dr. Cook. Good to see everyone. I'm going to do most of the talking today because Matt is just getting home from his honeymoon. So he's still trying to get his head set on what's going on in the world while he's been sipping Mai Tais on the beach somewhere in Mexico. So with that, I will share my screen and we'll kind of walk you through what's going on with the world and how the portfolio has responded to it. From a governance perspective, I guess we'll start there. Actually, this quarter is the deep dive from an investment perspective. So we always go pretty deep on investments, but here we pick out a couple of the themes that we've had implement in the portfolio and talk about how they've worked and what the outlook is. So we'll dig in on a couple of those. Page 7 just outlines really what those were, what our themes were going in the beginning of the year. So obviously, kind of a shift in terms of this global pandemic, in terms of where we had been the last 2 years and where we are this year, just in terms of things being reopened, economic impact, supply chain disruptions, bottlenecks, you name it. A lot to work through. Obviously, a close eye on the Fed and what they're going to be doing. That goes hand in hand with that third bullet about inflation, right? We've seen inflation, year-over-year inflation run at 40-year highs, north of 9%. And ultimately, the Fed has really put the pedal down in terms of raising rates in an effort to start to rein that in a little bit. And really all the things, that have gone on in the markets on top of some geopolitical events. We expected a lot of volatility going into the year, and that has certainly been the case. Both on the risk asset side or the equity side, but also in the fixed income side. And we'll dig into that a little bit more here in a minute. The results, and as I think everyone flipped through the book and probably heard just reading the journal or the paper or listening to the news at night, markets have been very difficult this year, down double digits really across the board, in some cases north of 20%. As a result of that, we typically come to you once a year and show you our forward-looking capital market assumptions. That's in the fourth quarter. The team that works on those, which I'm part of, we do the analysis every month. Typically looking at a 10 or 20-year assumptions is not going to change a whole lot month over month. But when you see this rapid of a repricing of securities, it becomes pretty meaningful. And as a result of that, we actually released updated assumptions as of June. They didn't dictate any change in the portfolio because, as you'll see, really everything across the board is in negative territory. So there was not a tremendous opportunity to rebalance portfolios. But on a go-forward basis, as difficult as things have looked in the rearview mirror, capital market assumptions on the fixed income side are up about 150 basis points on the average across the various fixed income asset classes. That's the result of a much higher current yield environment we're in. And up about 100 basis points on the equity side as a result of repricing of assets, the valuations, and also an increase in inflation is one of the inputs there. So On a go-forward basis, we expect forward-looking returns to look quite a bit better than we did at the beginning of the year, given the result of this sell-off. So a little bit of a silver lining, and obviously this is a longer-term pool of capital, so we do have the benefit of time to kind of work our way through some of these volatile market environments. As I mentioned, fixed income, typically when we see equity markets sell off, fixed income holds in okay. That has not been the case this year. It's actually the very worst start to a year, first 6-month period of a year that the Barclays aggregates ever experienced, dating back to 1976 at its inception. And spreads, or basically the additional yield you're picking up for taking higher risk securities in the fixed income markets, gapped out as well. So both treasuries, corporates, high yield, securitized debt all really struggle. It's really a no place to hide scenario, really with the exception of cash, which, yes, it didn't see a kind of a price decline from rising interest rates, but with inflation at running at 9%, certainly eating into the purchasing power of just holding cash as well. So really no place to hide in general. I'd say the positive there is that on a go-forward basis, we haven't seen a positive fixed income environment in quite a while. So the current, this chart here on the left just looks at just how good of a predictor the current yield is to the 10-year return of the Barclays Aggregate Bond Index. You can see they're almost a 1 correlation. So as we sit now, we're at about a 3.7. That was at the end of the year. It's actually come down a little bit, but about a 3.7 current yield on the ag. If you look at forward-looking break-even inflation rates, so basically the market's estimate of where inflation will be over the next 5 and 10 years, despite things being very heightened right now, those levels are at about 2.5%. So that means that we actually get a positive real yield of 1.2% for owning core fixed income, and that's not something that we've had in north of 5 years. So on a go-forward basis, fixed income investing looks a lot more attractive, although the rearview mirror looks very difficult in this 6-month period that we've been in. So certainly some more opportunity in fixed income, also some opportunity for active managers to take advantage of that dislocation in the credit markets. I will touch on the managers there as well. The other thing I'd say here is just a dispersion in returns across equities. So we've talked for, I think, as long as we've been working together about how growth has been really the stalwart of equity market returns here in the US and really globally. We've seen that flipped on its head this year as well. The market, given this rising rate environment, has really kind of taken a pause on how they value growth assets. And as a result of that, some of these very high valuation companies that people are willing to pay up for, given their future expectations, have had a very rapid repricing. And you can see in this chart here that the highest quintile of PE, so the most expensive stocks, year dated down about 30% through June, whereas the cheaper stocks actually positive for the very cheapest and just modestly negative for that next quartile. So a pretty rapid shift in market leadership and just a tremendous amount of dispersion, which has made it pretty interesting for active managers. Anyone with kind of a very pointed approach or concentrated approach, either in favor of value or having more of a valuation twist, has looked very good. Anyone with a kind of a high growth profile or willing to make some bets on some of those higher valuation companies has really struggled. The other thing I'd say is that if you remember the acronym, the FANG stocks, so Facebook and Netflix were two of those. Those were the stocks that really generated the vast majority of returns for US equity markets over the last decade. With this kind of rapid repricing, Facebook, which is now called Meta, and Netflix are actually being constituted by Russell as value stocks. And actually, Facebook is now the 6th largest holding in the Russell 1000 Value Index, which is pretty wild to think about the implications of that. If you're a value manager, you're really going to go out and buy Facebook. Maybe you are, but it's not a company that you ever really did much work on. If you're a growth manager that's had a long-standing position in it, are you going to remove it from your portfolio because it's fallen out of the benchmark? If you're a passive investor, just what you own underneath the hood and your value exposure looks drastically different today than it did 6 months ago. So pretty interesting market environment as a result of this pretty sharp decline and rapid decline in some of these large growth companies that we're very familiar with. The other thing I'd say, bull and bear market, a couple things to look at here. I think this chart does a nice job. Bear markets tend to be shorter in duration than bull markets, and the declines tend to be far less significant. So over time, we typically see pretty stable growth, and in bull market territory, we like to call kind of bear markets a point in time scenario. Certainly not anything that's pleasant to kind of wade our way through or work our way through, but in the grand scheme of things, still a great ability to compound capital over the long term. And the last thing we did was take a look at, how equity or securities perform after a rate cycle, a Fed rate hike cycle. So the expectation from the market is that the Fed is going to hike rates somewhere between 3.5% and 4% by the end of the year. We'll see if they go further than that. We'll see if inflation starts to come down. But generally, for the 6 and 12-month period after that rate hike stops, or typically that's coincided with kind of coming out of a recession, markets tend to do pretty well. So again, trying to paint a little bit of a silver lining here, focus on the longer term nature of these assets, and not get too caught up in what has been certainly a very challenging start to the year. I'm going to just roll it right into the capital markets, and then I'll pause for questions, just because these two sections kind of go hand in hand. And I touched on a couple of these categories, but the key themes is obviously inflation and the Fed's response to that. The market likes to talk about recession, certainly a much higher probability of recession right now. The argument right now is what defines a recession. We're technically in 2 quarters of negative growth, which has kind of been the standard definition, although politicians are kind of revising that as we speak. So ultimately, we're certainly in a softening economic standpoint. We'll see if the Bureau comes out and actually declares this a recession. But here's what I mentioned about the Fed funds rate, about a 98% chance, at least what the market's pricing in, of settling out with somewhere between 3.5% and 4% on that Fed funds rate by the end of this year. Here's that chart I mentioned and break-even inflations, right? It's pretty wild to think that we're very concerned about 9% year-over-year inflation right now, but even 5 years out, the market expects that to come back down to about 2.5%. So still north of kind of the Fed's 2% target, but certainly much more palatable and much more in line with history than what we're experiencing today. I think another interesting chart on this page is that typically the markets are about 6 months ahead of what the actual economic data is, both at the peak and at the trough. The markets are generally pricing in economic expectations rather than actual economic events here in the short term, and we've seen that time and time again. So even if we're in a recession right now, even if the data continues to come in weak, likely the markets are ahead of that, and kind of looking forward at that bigger picture and returns on a go-forward basis is important. And not getting kind of too caught up here in the short term and trying to make some active decisions around it. Here's the asset class returns. As I mentioned, very negative across the board. The circles, as just a reminder, the quarter to date returns, the bars are year to date. So I mentioned core fixed income down 10%, long duration, so more interest rate sensitive securities down 22%. It's having a lot of impacts on pension management right now. Spread sectors, high yield, EM down as credit spreads have gapped out, and the dollar has been very, very strong here to start the year. So non-dollar denominated debt has really struggled. In addition to that, across the equity markets, U.S. markets down about 21-22% on average, looking across the cap spectrum. Foreign markets a little bit better. On a local currency terms, actually foreign markets have held in quite a bit better. The local currency returns for EFA through the June were only down about 6%. So the difference between that 6 and 20 is really the strength of the dollar for us US dollar-based investors. So big headwind there, probably something that's not sustainable longer term, but certainly could be here in the short term as US rates here in the US are quite a bit higher than they are overseas, although we're starting to see other central banks keep up with us, start to catch up with us. Really, the only thing that's worked is commodities, and even commodities sold off in the quarter, but up about 18% year to date. We've touched on commodities and other real assets generally responding positively in inflationary environments, which we've certainly seen. Any questions on the markets before I kind of flip it over to the portfolio and talk about how we're positioned and implications of all this?
I think, Mike, for me, just more some feedback. It's really, really helpful to get that context from FIA. And again, I think for Trustee Roldan and for John Tudrin, taking slide number 11 and working that into the future ways and means conversation, I just think that that is a wonderful distillation, Mike, around what bear and bull markets look like. That's a nice visual for our trustees to have some context. Again, the things that I'm writing down, even you're framing around fixed income, you're framing around, I don't know what the acronym is, FANG, MAMA, like Meta, Amazon, like
Yeah.
to know there actually is some value in those that really dominate some of these conversations. Like, again, all that outlook is really helpful framing, as dare I say, as I don't know what the term of art would be, modest as our outlook tends to be, the way we've built our investment structure. All that is just really helpful. And I again, want to be sure you had that feedback.
Sure, appreciate that. And certainly, welcome to use any of this material, or if there's something we can put together for a Ways and Means committee or a board meeting, if you ever like us to come in for the full board, I'm certainly happy to do that. So from a portfolio standpoint, a couple things. Our dollar cost averaging program didn't work perfectly, but it worked to an extent, right? So the goal was to try to not take that full $10 million and throw it in the markets all at one time and kind of hit this 20% downdraft. So we didn't avoid it completely, but we certainly avoided it to an extent with that. So we had the last trade go in at the very beginning of the second quarter in April, the last movement from the short term to the long term. So again, we didn't miss the full extent of the drawdown, but certainly some of that capital at the later end of the process was deployed at more attractive levels than it would have been in the front end of that curve. So that did work to an extent. Again, it's longer term capital. We're never going to get it perfect, but I still think a thoughtful approach to allocating that. But that's done now. From a return or from an allocation perspective, pretty close to in line with targets. As I mentioned, it feels like we should have had a rebalancing opportunity given how drastic the equity market declines, but because fixed income was down notably as well, there wasn't a lot of capital to redeploy. Through the end of June, we were about 1.5% overweight fixed income and basically that much underweight on the equity side. So that would not hit a trigger point as far as we're concerned, especially at this level of volatility to rebalance. Also a little bit overweight on the market alternative side, which held in pretty well in this market choppiness, but pretty close to in line with targets. Targets for the underlying strategies, each of the underlying strategies right in line with their targets as well, as you might expect. And then from a return perspective for the quarter, the pool was down about, the long-term pool was down about 11%. That was about 70 basis points ahead of the benchmark. On a fiscal year-to-date basis, down about 11.7, which was about 140 basis points ahead of the benchmark. So certainly not avoiding the absolute downdraft, but hanging pretty well from a relative perspective. And I think some of the themes that I mentioned in the portfolio and how we've been postured has helped with that. Obviously hasn't offset everything completely, but certainly been a positive. Looking at attribution, most of it for the last year has actually come from the manager side, which is a positive as well. So for the 140 basis points of outperformance, 120 of it came from the managers. Actually, the allocation was modestly negative, and just the timing around some flows and putting those $1 million chunks to work was slightly positive as well. Most of the outperformance came from the domestic equity sleeve, but we also got some from the international side and also from Ironwood on the market alternative side. So I'm happy to see the managers performing well in this difficult market environment. And you can see that in the results. So on the fixed income side, a couple things. We've been kind of leaning heavily on BlackRock Strategic Income to be more tactical and flexible in this rising rate environment. They've done just that. They're only down about 5.5% versus down 10 for the ag. MetWest didn't hold in quite as good. They've been a little bit longer duration than the benchmark in a kind of a de-risking mentality, which was a headwind for them. And then Brandywine, which had been a very strong positive for the portfolio, had a very difficult quarter with just how strong the dollar has been. That's something that we'd expect to bounce back pretty quickly, but certainly here in the short term, a headwind for Brandywine and how they invest their portfolio. On the domestic equity side, I mentioned pretty notable outperformance there. A good chunk of it coming for this period from the small cap managers. So both Boston Partners on the value side and in particular Conestoga on the growth side, a notable outperformance relative to their benchmarks, given their approach, which is a positive. Similarly, on the foreign side, both MFS and Dodge and Cox were notably ahead of their benchmarks, both for the quarter and for the fiscal year to date period as well. Real assets has kind of held in line with benchmarks on an absolute basis. Owning that in the portfolio has certainly been a positive. We don't see that relative to the benchmark, but if we just had it against a broad equity fixed income allocation, owning real assets would be a very big positive. So that strategic allocation has certainly helped preserve capital to an extent. And then the market alternative side, or the hedge fund side, actually fiscal year to date only down 40 basis points. So kind of using that to adjust the volatility and the risk profile of the pool without owning traditional fixed income has been a really big positive. Over 10% of outperformance from this Ironwood strategy, formerly Atos, when we made that transition, versus what we could have gotten just by owning fixed income. So, I think generally things, no changes to the portfolios that we're making. We're always evaluating it. We're actually doing a deep dive right now on just benefits of owning global bonds, given where U.S. rates have moved to, and is it still worth it? U.S. rates look a lot more attractive than just traditional developed market rates currently, but that's certainly not the case with emerging market debt, and certainly not the case with what the strength of the dollar has been recently. So we're having some debate internally there on that exposure. But pretty high conviction in the rest of the managers, and I think generally things are holding in pretty well. So I'll pause there and see if there's any questions.
I'm just curious, Tony, not to put you on the spot, if anything else jumps out from you in that overview.
Yeah, I mean, definitely good relative performance on some of the managers. Just another terrible quarter. A lot of negative, nowhere to hide. But nothing that I find surprising.
Again, that's my feedback, Mike. I feel like Fiducian's been talking about these entities for a long time. Conestoga, that it's nice to hear them and to have that level of familiarity. Again, it's just great to have the synthesis. And again, I'm thinking we have some new trustees that we want to really bring up to speed and educate on what is this portfolio, what's this investment approach that is still relatively recent in its creation. So again, when you're sharing with us that our value was derived by and large managers, again, there's some discretion in how Fiducian has mapped that out. That really shows us the value that we're getting. It's just really helpful to have that point of reference.
Sure.
Dr. Cook, I agree with you. I think the info that's really well set up, and you're right, it's nice to have that info.
The other thing to remember too is, and it's a good example, right? June felt terrible. Not a lot of great news out there. July, the markets were up almost 10% across the board. So it's really hard to predict, trying to get cute and say we're going to de-risk things over time, or because the market feels like we should be, or things are challenging, is generally the wrong answer. And so we've already, been able to, who knows if we've actually hit bottom and we're on the way back up. Maybe we'll see some more downward pressure, but certainly for groups trying to de-risk at the wrong time, and missing July has a huge implication on just their ability to compound capital into the future. So staying strategic and long-term is really important. Flipping over to the short-term pool, we weren't able to escape the negative pressure here either. The short end of the curve is what the Fed controls, so that has shot up dramatically. So even short duration bonds are going to be impacted by this, although not to the same extent. For the quarter, it was down about 1%. For the fiscal year to date, down about 2.6. Again, certainly the yield profile of all these managers on a go-forward basis looks a lot more attractive. I mean, for money market now, you were getting basically 30 basis points because we were in this MMDT product. If you were in a traditional money market, you're getting essentially zero. Money market yields are now, with the Fed raising rates last week, up around 2% in certain circumstances. Both Payden is paying somewhere around 2.4% now on a 30-day SEC yield. And certainly the TIAA-CREF social choice, which is more intermediate, that's going to be somewhere around 4% today. So again, going forward, the yield profile of the short-term pool is quite a bit more attractive. And pretty quickly, unless we see a really rapid rise in the curve and rates across the board, we'll see these negative numbers turn positive as we start to clip those coupons. So much more attractive on a go-forward basis, and it's generally held in okay here in the shorter term.
Mike, do you have like the average duration of the short-term portfolio?
I could probably back of the napkin off the top of my head pretty quick, Tony, but I can get you an exact answer. So Payden is running at like 0.4 years right now. Vanguard short term is going to be about 1.2 to 1.5. And then TIA, we do pick up some duration exposure in TIA, which is going to be, basically right on the ag, so around 6 years. So I think if you were to blend it all together, the money market's going to be essentially zero.
Right.
It's probably somewhere around 2 years, maybe a little bit less.
Okay.
I think for me, Mike, this is where I would introduce a little bit of sort of operationally where we position with enrollment in our college budget, given the divestment that we have sort of forecast to ensure balanced budgets this year and of course going forward. The short answer is, and we'll want to make sure that you're real close on where our enrollment is, but we are running year over year about even, which for us is really good news. In our case with enrollment, we're always real curious if and when, however we want to define a recession, we tip into that if we see students come back to us like they have typically in more typical recessions, right? COVID aside. It helps because budgetarily we budgeted to be down 6% this year. So from a fiscal standpoint, we're doing well. Again, I don't want to force my CFO's hand, but it may change how much and even the timing of divestment with all of you on the budgeting process. So again, more to come. We'll obviously want to stay real close on when and how we manage that part, but obviously we're going to have more cash in hand. And that could have some influence.
Okay. So that was everything I had prepared, the normal update. But again, happy to answer any other questions or feedback or comments or any open discussion we can contribute to.
Yeah, to our one trustee, Norm, I just want to double check if you have any questions about where we are or what's ahead.
It's nice to see and learn. I don't have actual questions yet. I'm still trying to, get the feel of this. So thanks for your patience and all that, and showing me what you guys are doing and that. So thank you. But just learning right now, guys.
And Tony, I'll be more intentional, but just like to circle back and utilize your time and talents. Anything else we should be thinking about as a college, especially when I share where we are enrollment wise?
No, I mean, I guess I was thinking more about it. I mean, my one question about duration in terms of where the yield curve is, obviously this is directed at Mike, but given, the expenditures or potential expenditures and the fact that the Fed's probably likely continuing to raise rates, would it make more sense to shorten the duration if you're saying the average is 2 years? I know that was pencil, off the, but would it make more sense to have a shorter duration within the portfolio just to prevent any further erosion of principal if rates continue to escalate up?
We could certainly do
on the short portfolio.
Yeah, I mean, we could certainly do that. I guess there's a couple things. So more than half of it is in half a year or less. So if we had to take liquidity, it's there. Where we're getting most of the duration is from the TIA fund, which is what we've used to get the ESG component in here.
Right.
And to my knowledge, there still isn't really a short term, ESG strategy that would facilitate that. We could certainly, with the guidance from the board, look to temporarily pull that out just from a duration management standpoint. And it with the intent of someday putting it, back in maybe once things settle out. I'd say the other thing that's a little bit unique, right, Tony, is that the Fed keeps raising rates, but the long end of the curve has gone from 3.5 to 2.6 in the last 3 weeks.
Right.
Which is basically like the market telling us that they don't expect inflation to be a problem, and there's a likelihood we're going to be in a recession in the short term. So it hasn't bitten us that much. And certainly with that higher coupon rate, it's a lot. We have a lot more kind of powder to offset any duration issues with that coupon over time. But you know, to your point is, I mean, if there's a real need, we might need to take some cash out of this thing in the short term, and it exceeds kind of what's in that money market position, then I think potentially adjusting the duration down a little bit does make sense.
And I can help with that, Mike. I mean, I'll own introduction of social choice and ESG position, probably coming up on 5 years ago. It's just never functioned. It wasn't just from an ethical standpoint. It really was intended. I thought Tia had a decent bond position, but it didn't do anything really for us in COVID, and it doesn't seem like it's doing a lot for us if in fact we're entering into this recession. So don't feel like we can't revisit that. I don't think, again, I had a board of trustees that was clamoring for it. We don't have a college that is knocking down the doors asking us about that kind of positioning. So
Yep.
I think we're a college that needs to maximize where we can, even if it is in these small ways in a short-term position. So all that is to say, I think we need to give ourselves permission to revisit that.
Okay.
Mike, could you pull up the page again? How much is in each of the funds in the
Yep.
short portfolio?
You can pull it right up.
So if I recall, it's what, 10%?
Yeah, it's about 10%.
Right. So it's not that that huge of a position. I guess my thinking was more talking about duration and interest rate risk was on the Vanguard short-term bond fund.
Yeah.
Just talking about liquidity, I mean, so there's right 30% or 1.7 million. So that, I mean, just, you know, given what's going on right now with the environment, you know, and you know, what are the needs from the short-term portfolio over the next 6 months or 12 months? And so I'm assuming when there are liquidity needs coming from the portfolio, Mike, you're, you know, depending on what's going on, you're, you know, figuring out where to pull it from exactly.
Yeah, and there hasn't really been, with the exception of having the cash come into this pool and then get deployed in the long-term pool, we haven't had a draw from the short-term pool in quite some time. I think it's been almost 2 years from like a draw from the short-term pool to fund operations or a project or anything. It's been pretty steady. So I think, you know, let us kind of do a little thinking around that. I appreciate the context, Dr. Cook, about the social choice. I don't think it's something that we need to kind of move away from entirely, but we could certainly adjust some duration exposure there a little bit. And we could certainly kind of, you know, Tony, to your point, you're not getting compensated a whole lot to own 2 to 3 years as you are from 1 year, right? It's basically the same yield today. So, you know, we could kind of shift that exposure maybe more over to Payton and just eliminate that part of the curve.
So I appreciate that, Mike. Nanette, do you mind just bringing up the agenda one more time for us? Should we just double check if there's any other questions? Tony, Norm, obviously, John, we've got some good elements we can work into Ways and Means next month. Because if not, go ahead, Norm. Yep.
Well, I agree. I think I have no questions, but just definitely following up more on the questions we had and the stuff that we're looking at to do, I guess.
Yeah, again, Mike, Chase, we're on track. We've got that major capital project award. We're again, you know, things obviously are real slow in the public sector in terms of design selection board for the architect and the project scoping. So we're still some time away for needing to potentially divest for that project. But in terms of operations and the underwriting of that, again, we'll know more, especially after our what we call freeze date on enrollment, which is later in September, to know budget wise where that has us standing. So
Okay.
So
Norma,
our next meeting,
yeah,
our
if you
next
want
meeting
to
is going to be, yeah. So next meeting is going to be on Thursday, November 10th, 4:30. So if there's, I guess there's anything else, you got any more questions? Motion to adjourn, which is probably me, right?
you get to move that and as well.
Okay, I'll move to adjourn the meeting, guys. Everybody have a great day.
All right. Thank you so much.
Thank
again.
you. Talk to you soon.
Congratulations on the nuptials. Take good care. Thanks again.
Yeah,
Thank you.
very good.
Bye-bye.